Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, as we begin another trading month now, we have yet another developing situation to assess as far as market impact is concerned, the Ukraine situation. And we're going to try and do that with Research Director Shiraz Mian and equity strategists David Bartosiak, who does a return engagement here at the Roundtable, and Brian Bolin. And I say return engagement because you did your first one last week, and we welcome you back, David. But I'm going to start with you, Shiraz. Russian intervention in the Ukraine put a definite drag on our stock market right at the outside this morning at the opening bell. Is it a drag at this point, or is this going to develop into a full-fledged headwind?
I'm hesitant to acknowledge that it could become a full-fledged headwind for the market. I think if it stays restricted to Crimea, I think there is a distinction that everybody needs to make between Crimea and the broader Ukraine. Crimea is and was always a Russian part. Mm-hmm. It was gifted to Ukraine by Khrushchev in the 60s. It is their warm water port on the Black Sea, and majority is Russian population, and they just took it back essentially. Mm-hmm. If the issue remains restricted to that, I think the rest of the world will acquiesce to Putin's grab of that, and the world will go back to normal in a few weeks' time. The risk is that Ukraine is in turmoil. The eastern part of that country is also very Russia-friendly, and if Russia starts meddling into Ukraine proper, then we may be in serious trouble. And all this heated rhetoric of sanctions and retaliation and all of that could start weighing on the recovery in Europe, particularly dampening Germany, and then it feeds into the broader global economy and us as well. So there is the risk, there is the uncertainty, and this geopolitical uncertainty playing in the markets as we are seeing today. But my sense is that if it stays restricted, it blows over in a few days.
So David, as we speak here, the market is down triple digits on the news. Market just spooked, you think, or is this going to be the catalyst that takes the market lower?
I certainly don't think it's going to be a catalyst taking the market lower. I think it's just, kind of slow news day, let's blame something. And the market's selling off a little bit, but, in the grand scheme of things, what did we close at on Friday? 1859 or something like that on the S&P. Mm-hmm. And here we're at 1840. So it's just kind of your typical, trading day, just trying to find a bottom end of the range so that we can, start trading in March.
What do you think, Brian?
Yeah, I think they're both wrong. I mean, go figure here that I'm going to be the voice of reason. It's kind of crazy to even say that, but the idea here is that up front, there hasn't been that much violence inside of the Russian grab for the Crimea. Mm-hmm. While that may be a historical thing, there's also 50% of the population that isn't Russian, that wants to be Ukrainian, and who in their right mind wants to be in the Russian economy right now. The ruble is plunging, has gone down over 20% against the dollar this year. Their whole economy is really is just a mess. The real key concern here with the Ukraine is natural gas. 40% of the deficit from the Ukraine is focused on natural gas. They get it basically only from Russia. So if Russia threatens to pull the plug and you don't get gas, well, it becomes a really cold winter, and winters are pretty long over there. So, that's going to be the real key concern going forward is how is this going to affect natural gas and really natural gas technologies, things like fracking, things like shipping of LNG, things like that.
So far, the market, again, as we speak, has looked past any positive U.S. economic data that has come out this morning since news broke of the Russian intervention. So what you're saying then, if I'm hearing you correctly, Brian, is as the week wears on, if the situation over there escalates, the jobs number coming out on Friday, market may look past that too and just refocus on this situation?
Absolutely. The violence is kind of the key thing right now. There's been very limited violence, but if that grows, the amount of uncertainty and instability in that region, could possibly spread to further parts of the Ukraine, to other parts of Eastern Europe.
What do you guys think?
Yeah, the risk is that if you escalate the issue into Ukraine proper, and we have a split of the country along the east and west lines, as many have been fearing, and then Western Europe and the U.S. They respond in ways like sanctions or other punitive measures, then the problem really escalates, because Europe, more than Ukraine, Europe is dependent on Russian natural gas. And we wouldn't put it beyond Russia to use those energy supplies as a lever in those kinds of situations. So there is the broader uncertainty and geopolitical risk that this move has brought back into the equation for the global markets, and then there is the risk of some of the possibilities that Brian is referring to.
Okay. At the moment, however, there are still some bullish market indicators that investors need to be aware of, correct? David, you brought up an important one in conversation, the NYSE bullish percent.
Yeah. So you take all the stocks on the New York Stock Exchange, and you figure out what percentage of these are in an uptrend versus what percentage of these are in a downtrend. And basically it's a contrarian indicator. So when you start to see that bullish percent get up in the 80s, that's when you typically have market tops that take place. And then on the flip side, if it's down in the 20s, that's usually a market bottom. So you can kind of think of it as, who's playing in the game, right? If everybody is in a positive trend and moving higher, something has to give, right?
And where are we at now?
We're at 62 right now, 62%, which is kind of typically where we see fuel for rallies further. So I'm not too concerned with where that's at, and I think there's plenty of gas in the tank overall.
Brian, you cite small caps as a bullish indicator.
Yeah, when small caps are running as they have been over the last several weeks, we had, I think it was like 13 out of 14 days where small caps closed positive. That was kind of the first time ever that something like that had happened. So that's a big bullish signal when people are really getting into, and that's an area of more risk. Your bigger caps are going to have a little bit more insulation from risk there. So when you see small caps running like that, that is an indication that there is a lot more people trying to get back into this market and trying to get more risky in names.
You cite investor sentiment as
That's right.
a bullish indicator, but for how long is the question?
That's right, and it kind of plays in line with what both of them referred to. And what I was referring to is how investors have played this persistent flow of negative data that we have seen January and February, and kind of see through it to a time when supposedly the weather will get better and we'll start seeing positive data. In fact, the data this morning on the ISM and the personal income was on balance on the positive side. So it's the market's bias being to the upside, and that's showing up in what Brian and David are referring to as well.
Okay, thank you all for that. Coming up in our next segment, as always, these folks here are going to give you their top stock picks, so click on over.